Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
With us is our Bloomberg News Big Tech Team leader, Sarah Friar, also author of No Filter, the inside story of Instagram. She joins us from the Bloomberg San Francisco News Bureau. So much going on, Sarah, but let's talk about Amazon. That feels like a pretty big number. 10% of the company's roughly 350,000 corporate employees. It's a report from Reuters citing unidentified people. We haven't yet confirmed it, but what's your initial thought on this?
Well, first of all, we are chasing it. But this is something that the companies all across the board have been doing since the pandemic era, what they call overhiring. A lot of these companies saw the growth in how people were relying on tech during the pandemic when they were home. They were obviously ordering a lot more from Amazon because they didn't want to go to the grocery store if they were at-home workers. And the company hired to accommodate that. And now they don't need as many people. But I heard your earlier point, Carol, about AI. I think that's part of it. But I also think that part of it is when these companies go through periods of opportunity where they see a lot of growth, they're seeing that trend line and they're hiring for the future. We're seeing it right now with AI. These companies are building out data centers. They don't know if they're actually going to need all of that capacity long term, but they better make that deal today or else they might not have it when they need it. So we do see a lot of anticipatory investment from these tech companies over time that sometimes they need to pull back on. In big tech, we haven't seen as big a pullback as we have in the past few years since the pandemic. It's really been a change in the culture, this drive for efficiency, for reducing bureaucratic bloat. And it's not just a line they're throwing out there. We are seeing my colleague Matt Day wrote a really interesting story I encourage everyone to read about AWS and how AWS was at the forefront of cloud, really inventing the market. And in the era of AI, they have fallen back in preference for startups. They had that big outage we talked about last time I was on this show. And some of the employees are attributing that to bloat, to this bureaucratic culture, too many people working on the same things and things not getting done fast enough. So I think, although I hate to see people lose their jobs, I think that is where a lot of this is coming from, the idea that we need these companies in the age of AI to be working faster to try to catch their competitors.
I see a headline like this, Sarah, and I immediately think back to the prominent other headlines that I saw in the last week about big layoffs or mid-sized layoffs at a tech company, Meta Platforms, laying off 600 people who work in AI, and then Target retail, not necessarily tech, but Amazon straddles that, right? And we don't know the details of these layoffs yet, but Target to cut 1,800 roles, 8% of its headquarters team. Taken together, is there a story with these three headlines?
Well, I think that the Meta headline and the Amazon headline are certainly related because they're all attributed to this idea of trying to move faster, to cut a lot of the, maybe unnecessary workforce, maybe workforce that they do expect one day will be augmented by AI tools or are already starting to be augmented by AI tools. But like we've said before, we don't know if the AI tools are actually making people more efficient. That right now it's more of a hope that will be the case. Certainly in coding, it's had a big role. I'm not sure, because we haven't been able to confirm the report just yet, I'm not sure if these are roles in coding. When it comes to Meta and AI, it's really interesting because they are still shuffling around the leadership and therefore the direction of this very expensive super intelligence team that they pulled together over the course of a few months earlier this year. And it seems like that is something that could give the potential of a slowdown for that company, but a lot is riding on Meta's AI efforts. Both companies, Amazon and Meta, I think we are going to have a lot to learn from this week in their earnings, which are coming Meta on Wednesday, Amazon Thursday. So I think that is going to be very key.
Yeah, totally agree with you that I feel like the earnings this week are a big deal to see that those AI investments are paying off. Hey, in the meantime, we're watching very closely what's going on with Qualcomm. They don't report until November 5th, but I'm looking at a stock, Sarah, that is up 12%. At its highs was up nearly 22% today. And this is after unveiling some chips and computers for the AI data center market. We know this is something that has made NVIDIA just on fire and at the center of the AI universe. What do we know about Qualcomm?
Well, they already have a major customer for these chips in the form of Humane, the Saudi company. And so I think that is giving investors a lot of hope that this can not only give them a very strong position in the AI growth as an alternative to NVIDIA, but also help make up for some of the revenue lost by Apple, who was a major customer, going to in-house chips. So I think they see it as very positive for Qualcomm. Of course, this chip is also getting a lot of buzz for its ability to hold quite a lot of DRAM memory. So I think, anytime that someone can make inroads in chips versus NVIDIA, the stock market is going to reward it, but we'll have to see if they're able to take on some of those big tech customers over time, or what their customer base is going to evolve into if this becomes a big part of their portfolio.
Yeah, time will tell. I was looking at our BI analyst in the Ian King story, basically saying, it's too soon to call this a serious challenge, right, to NVIDIA's dominance. Even modest share gains, though, in the over $500 billion AI accelerator market could translate into billions in incremental revenue. Right, even this pie is so big, and it just seems to grow at this point, Sarah, that even a piece of it, or a decent piece of it, it could be a lot for Qualcomm if it all plays out.
No, absolutely. There's so much data center build out happening right now, and happening over the course of the next few years. I think we're going to continue to see these multi-billion-dollar deals across the U.S. and around the world. So I think that any player that can get in on that build out it's really significant, and I think that the time is really now. Chips don't last very long once they are unveiled. They maybe last 3 to 5 years before they're obsolete. So I think for those deals that are in the making in the moment, we're very interested to see what Qualcomm's gonna cook up.
Sarah Friar, thank you as always. She is Bloomberg News Big Tech team leader. She's out there in our San Francisco bureau. Sarah Friar, also the author of No Filter: The Inside Story of Instagram.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Great to have back with us Jan VanEck. He is Chief Executive Officer of VanEck. It has about $133 billion under management, AUM, and he joins us back here in our Bloomberg studio. Jan, great to have you back with us. There is a lot coming at investors. There is this laundry list. What's most important to you when you think about the investment environment, and what shapes your strategy right now?
In keying off of this monetary policy discussion, I just have to say that the big piano hanging over our heads to me is the federal budget deficit. And since I saw you last, we actually got some pretty good news for fiscal 25, that as a percent of GDP, the budget deficit had fallen from 6.5% to 5.9%. I've been focusing very much on the year that we just started on October 1st, because I think that's the big risk, right? The Fed, the federal government has to borrow or pay $1 trillion a year.
Yeah.
And sure, the Fed governor, affects that, but what the markets think matters a lot too. And if we can reduce that pressure by having better finances, that's really good news for the market, I think.
But that's not an argument for having not an independent Fed, right? You still want a Fed that does monetary policy according to inflationary pressures and labor pressures.
Right. But what the wonky economists on Wall Street don't want is to have so much debt that you basically are forcing the Fed to use something like Japan did, yield curve control, or some really extraordinary measures. That would really be unwelcome. So, we can talk about the personalities and everything, but right now the direction of movement is good compared to coming into the year where we had a lot of fiscal concerns, and the Fed chair would have had a lot more on his plate.
Jan, when you were on with us last, it was about a month ago, it was just before the government shutdown, and we asked you about whether or not a government shutdown actually matters to markets. Well, here we are, a month later, and
it's amazing.
It is amazing. I mean, it's the second longest shutdown in history. Entering, it's remarkable to see. You said it didn't matter,
right?
Do you stand by it?
Yeah, I mean, I don't think there's any evidence that it has mattered. I think what's really worrisome, though, is the fact that
But it's a dysfunctional government. You have a whole branch of the government that isn't working.
That they don't care, right? Neither party really cares if something bad is happening, if they feel like the other party can get the blame. And again, I don't mean to only talk about the debt problem, but that's really what we all worry about at the end. Like, will we never solve Social Security? Will we cut Social Security payments in 2033 like we're scheduled to?
Yeah.
I mean, those are the longer term concerns.
When you look at this market environment, the other things that are coming, and these are obviously the ones that we just talked about, are super, super big. But I do think about our focus on, these Mag 7 earnings. We get a big drop this week, and we'll learn once again whether these AI investments are paying off. Last time around, we saw it with Meta and some of the other big hyperscalers that these investments seem to make sense at this point. The AI trade, where are you on that?
It's going to AI. We have a compute shortage that's very visible to the whole world. And what's really interesting, I did some research on this since we last talked, and OpenAI is really emerging as the giant in this area. So they have 800 million monthly active users. The next biggest, Gemini, has 450, but much more interesting. So your average website is now getting basically traffic coming from the AI chats somewhere between, let's call it 1% at the low end and 17% at the high end. Of the traffic that's going to your average website, like the Bloomberg website or the VanEck website.
We're not average, just so you know.
Sorry. Sorry.
But go ahead.
Sorry. I can't believe I said that. But of that traffic, OpenAI is generating over 90% of that traffic. They are completely dominating the other Mag 7 companies when it comes to that. Now, on the flip side, they are trying to build out a ton of this compute, and they don't have the money, right? All the other hyperscalers have a lot of revenue.
Not public.
Right, and the revenue is only 40 to 50 billion. So, and they want to spend hundreds of billions on compute. So that's the one thing that I look at as a potential weakness in this AI trade. But otherwise, we've got at least 2 calendar years of demand to deal with.
So you're not seeing ghosts of the late 90s tech crash here?
As I said, the only vulnerability I see isn't this sort of systemic thing. It's one company that's spending a ton of money, and so far they've been able to raise it. Everyone else has got the revenue to cover their spend, right? I mean, they've got the cash flow.
And I'm sure in OpenAI can keep raising money. It seems like there's plenty of demand, or maybe even do. Are you doing ChatGPT right now, Carol?
No. I was actually no.
She did just grab her phone.
I did just grab my phone, which is such a no when you're on air. Lisa Abramowitz, who we all she's incredible on surveillance on the TV side, and she said the Mag 7 stocks have accounted for almost half of the S&P 500's 15% gain this year. Microsoft, Alphabet, Amazon and Meta are expected to post a combined $360 billion in capex in their current fiscal years and nearly $420 billion next year. So what I'm just wondering is the market, we've talked about that we feel like in the earnings season, we're seeing breadth expand. But again, these companies are still so important, right, to the trade.
Yeah, they're really, we want to ask ourselves, why do they have such a high percent of the S&P 500? And we have an answer, because they're profit dynamos. Not only is their revenue going up, but their employee bases are flat, if not shrinking. So rising revenue, flat costs, because one of the big beneficiaries, obviously, are software companies.
We have 30 seconds on gold. This is where I want to go.
You are going to go there.
Yeah, is that where you were going to go?
I was going to go Qualcomm.
Okay,
go ahead.
So down 8% from its peak. Further to go?
Yeah, 20% correction in the bull market would be my base case.
That's your call, $3,500?
Yeah. Yes.
Okay.
Still not a bad year, right?
Great year. I think the question is, everyone's impatient. They're already looking at their phones and during interviews. The question is, how long does gold consolidate? Right?
It was for the goodness of the show.
A whole 12 months of consolidation would bore the market. So we may have one of those situations, but still, we like it long term, for the next decade.
Shawn VanEck, he is, of course, Chief Executive Officer of VanEck, joining us here in studio.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to know how Sarah Hunt is looking at all this. She's partner and chief market strategist at Alpine Saxon Woods. The firm has about $850 million in assets under management. She's here in the Bloomberg Interactive Brokers studio. I guess we should probably start with trade because that is what is pushing this market higher today. Dare I say, or ask you, is it getting ahead of itself given that we don't know if this deal will happen?
I think that's been one of the biggest questions all year, because when you had the meltdown earlier in the year in April, and then you started to see those deadlines move around and all those things change, and markets were much happier with that, right? Because they didn't want to hear those draconian numbers. They didn't want to see that happen immediately. So you've seen things continuously move around. So I'm sort of surprised that there's enough surprise in the headlines every time we get one that it does do that. But in the end, if we can get things sorted out so that you don't have pecuniary tariffs anywhere, or at least not as bad as we thought they were, there is a relief to that. And I think that that's part of what you're seeing. And I do think that there's a de-escalation of tensions, because the rare earths thing has really been an issue ongoing for the last several months. So I think that all those things together and the low CPI print on Friday really helped.
But we still have, as we mentioned earlier, Sarah, China still faces effective U.S. tariffs of around 40%, about 25 percentage points above the global average. I mean, we are in a different tariff environment. So I agree that I think, flooding the zone, we're all exhausted, so we just want things to land, and we almost don't care where they land, which is kind of crazy because they're landing at different marks that are going to impact profitability, it sounds, of companies. So that's going to have an impact, and I'm not quite sure when it starts to really, really show.
And I think that that's also the million-dollar question, because that has been the issue going forwards. What's going to happen to margins? What's going to happen to pricing? What can consumers absorb? What can companies absorb? And the truth of the matter is, we haven't really seen the effects of a lot of those tariffs, because a lot of them came and went, or they get suspended, or you get carve-outs, or you get different pieces. It's very difficult to pinpoint exactly who's paying that 40% right this minute.
Right.
And until you start to see it come through earnings, and until companies start to talk about it, it becomes more and more difficult for people to put in their numbers. So right now, numbers look very good, and I think the third quarter is going to be pretty good. This week is going to be a very big week because we have a lot of people reporting, and that's going to be very important how that comes out. But where we go with those and what that does to margins, I think, is the biggest question that we still don't have an answer to.
Is that when, not if, these companies start to see the effect of these tariffs?
It is definitely a when and not an if, but the when keeps moving around, and that's why it's hard to take a victory lap, which some have done and said, well, there's no real effect of this because you've seen the earnings still be very strong, when in reality, we don't really know what the effects are going to be because you keep pushing things around and inventories have been pulled in.
So then how do you position for that?
You try to find places where you think you are not in as much risk as you would be if the inventory picture is not good enough and or changes, and you don't get a chance to reduce that or to put that inventory back in. So a lot of the places are going to be obvious. The technology stocks are part of that, although you have seen NVIDIA have issues with being able to sell and then not sell chips and everything else. It's the cash generative areas, the places where you know that there might be some pain. It's almost more to avoid it. I mean, I wasn't thinking about Mattel when I started when I started this, but if you think about something like Mattel, that was a very bad situation for them. And that you are seeing that now, and you will see that in other areas.
But it's not like we're going to see Barbies built here in the U.S.
No, that's one of those things where you'd almost think that like certain things are going to need a carve out because you're not going to bring them back. Whether or not toys are going to end up getting that, it doesn't look like it right now. But no, there are certain things that it doesn't make any sense to do that with.
Well, maybe Barbie's a good example, because what did the president say about Barbie earlier this year? Maybe if we only get one Barbie at Christmas, it's
kids, girls,
something like that.
Whoever. Don't need
two Barbies instead of 30.
I don't know.
Yeah.
When I was growing up,
that was what he said.
The more Barbies,
Thank you,
the
Ari.
merrier.
Ari's chief. I was going to say he's chief Barbie buyer in his house.
Well, he's got a daughter. What I'm wondering is, are we though moving towards an environment where we're not going to have companies that are as profitable as they were before, which is kind of mind-blowing because we just saw the banks being really profitable. The earnings season, we're seeing it broaden out, that a lot more companies seem to be coming in with some strong profit numbers, revenue numbers too.
It's one of the biggest conundrums, because in the end, to maintain that profitability, if you do start to have things like tariffs bite, what do companies do? They get rid of costs. How do you get rid of costs? You get rid of people. So what do we not have right now? We don't have any employment stats, right? We don't have any statistics on what's going on.
Although Amazon is cutting, 10%, 12% of its corporate
10%.
workforce. We just got that today.
I saw that note before I came in here, and I thought this is one of those issues, because you end up with having unemployment problems, and that is going to be fine potentially for margins for some period of time, but they can't do that forever.
Right, because we're the people who spend, right? And if we're not working, we're not spending. You know, it's interesting. Drew Mattis, Chief Market Strategist over at MetLife Services and Solutions, was on with us last week, and he talked how looking at the K-shaped economy, but just saying it's not okay. And he was really talking about the upper rung of the K, that even upper income consumers, like maybe these corporate folks at Amazon who have had good salaries and good benefits, but if they're being let go, then we've got a problem, right? If the upper end of our economy is also going to maybe be struggling.
Well,
we know the lower end has been.
Right.
So I'm sorry, go ahead.
Well, no, I was just going to say, and it's harder to get another job too, because people stay in jobs longer, and there isn't as much movement right now, and that's an issue as well. And I'm sure that there are a lot of people who are going to be surprised by that in Amazon, because nobody was looking at Amazon saying, "Oh, we really think that they're about to lay off a bunch of people." No. Sort of like when Meta laid off a bunch of people on the AI side.
Yeah,
when they had been
600 people
poaching
last
other
week.
people
It was announced
on the AI side. Now those guys were not getting paid very little; they were probably getting paid quite a bit.
Right.
And that's so yes, you're into that layer of the people who are getting paid quite a bit of money, who are now looking at losing their jobs.
So just 30 seconds on the labor market. It's okay? Weak?
It's not
Weakening?
moving.
Needs a Fed cut?
It's well, and is a Fed cut going to save the labor market too, right, is the other question. But it's also, there's been less movement, and it's hard to tell what's going on, because you also have the immigration story behind that too.
Yeah.
So what is the right number? What's the break-even number? And all of those, we don't know the answers to all those questions, and now we don't have any data. So it just makes it much more complicated.
20 seconds. Do people want to still put money to work in this environment?
They have to a great degree, right? Because sitting in cash, especially if we're going to cut rates, that lower end of the money market is going to start to come down, and people are going to be start looking at it. And also, when the market moves up like this, people feel like they want to participate.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Shawn Donnan and Brooke Sutherland are two of the writers of the team behind this feature. Shawn is Bloomberg News senior economics writer, and Brooke is Bloomberg News Boston bureau chief and writer for the Bloomberg Industrial Strength newsletter. Shawn joining us, Tim, from the Bloomberg Washington, D.C. bureau, Brooke out there in our Boston bureau.
So, Shawn, I just want to start with you and put this $4 trillion number into context when it comes to economic growth here in the U.S. over the last few years, and those estimates moving forward. How does AI spend figure into growth, and sort of where would we be without it?
Yeah, look, and the answer, and we hear this from all sorts of analysts and economists right now, is that the U.S. economy would look a lot weaker right now if it wasn't for this AI investment boom. There's something like $400 billion in CapEx being spent this year. That's adding as much as a percentage point to growth, or that's certainly what it added in the first half. People are thinking about next year and thinking that it's going to add 1.5% percentage points to growth next year. That's significant in an economy that's growing at 2 to 3%. And it's just this thing that is enormous, that's historic, but it's also something that's masking weakness in other parts of the economy and may in fact be, some people think, causing weakness in other parts of the economy, like manufacturing.
And that's what we want to talk about. This on a day, I got to say, guys, I feel like every day there are multiple stories or multiple headlines about the AI spend, and it just ties into what we're talking about. One, crossing the Bloomberg, NVIDIA and Deutsche Telekom plan a 1 billion euro data center in Germany. Not the U.S. economy, but this is happening around the world. Shawn, come on, Brooke, come on in on this conversation, because the president was very clear on the campaign trail about wanting to bring manufacturing jobs back to the United States. But we keep asking guests, is the AI spend squeezing out CapEx spend in a lot of other areas, or just spend overall in other areas, including manufacturing?
I mean, I think that's the real question. And, to Shawn's point, just the flood of capital into these AI data center construction projects is really just staggering. And what you constantly hear in the U.S. is that we do not have enough workers in the construction and the manufacturing field. And so from a construction standpoint, as you talk about wanting to reindustrialize the US, I think there's a legitimate question of, can you do that at the same time as you were building all of these data centers? Can we do both at the same time? And not just from a worker perspective, but also from an energy need perspective. And then, in terms of where the capital is going, to your point, I do think the return is a lot better on data center projects right now than it is for much of the manufacturing industry, which really has been, in a slump for the better part of 3 years outside of those industries that cater specifically to data centers. So things like electrical equipment or gas turbines are seeing really robust demand from those technology comments, whereas everything else has been really, really sluggish, and also, hit harder by the impact of tariffs and the uncertainty that unleashes. Okay,
Brooke, I'm glad you brought up tariffs, because there's a really important paragraph in this story that talks about the effect that some of the companies in the industrial space have had as a result of these tariffs. I mean, we're talking billions of dollars here. Of the companies that you cover in the industrials world, Brooke, how have tariffs affected them?
I mean, I think tariffs have really kind of put a hold on a lot of things from a manufacturer's perspective. What I hear over and over again from CEOs is it almost doesn't matter what the actual rate is. Of course it does matter, but they just want to know what it is. And then they can adapt to that. They can move their factories, or they can rejigger their supply chain and shift, certain things around to try to mitigate the impact. What's hard for them is when the rules of the game are constantly changing. And we're seeing that continue to play out, where there's new tariffs announced or taken off, or a different deal struck with different countries. And that's very difficult if you are a CEO and trying to figure out what to do with your business, especially in an industry like manufacturing, where these investments are very long term, and you need to sort of forecast what the world is going to look like a few years down the road. And if you don't really know what the world looks like today, it's a lot harder to think that far ahead. One of the things that's interesting here is that, the Trump administration has been more willing to look at exemptions for certain things that play into the data center market, but not everything. And, the electrical equipment manufacturers, have pushed back against some of these tariffs that do hit them, because they're already struggling to keep up with all the supply that we're seeing from data centers, and tariffs make doing so even more expensive.
No, but it's interesting, right? I mean, Shawn, this idea that the Big Beautiful Act that was passed, one Big Beautiful Bill Act that was passed, there were a lot of folks within the manufacturing sector, if I think about the National Association of Manufacturers that you guys include in this story, that campaigned in favor of this legislation, but as it's turning out, they're maybe not so necessarily sure that it's going to be that helpful.
one of the things that they found was that manufacturers as a group were planning only a 1% increase in CapEx over the next year, which is kind of right in line with what we've seen in previous years, and that's not even adjusted for inflation. I think one of the key points, if you talk to manufacturers, is in the One Big Beautiful Bill Act, there are these provisions that would allow them to claim back the cost of capital investments, and that there's kind of beneficial tax treatment there. But at the same time, this is an administration that has tariffs in place on a lot of machinery from overseas that would be needed to kind of fulfill that capital investment to come in. So if you're bringing in a machinery from China, you're facing a 50% tariff on a multi-million-dollar machine going into an American factory. That's a huge cost. And that's very different from what you've seen on the AI and data center side. So April 11th, a few days after Liberation Day, the administration quietly on a Friday night put out some pretty significant exemptions for consumer technology, but also things like AI servers and other components that go into data centers. So that AI investment boom is also largely, although not entirely, as Brooke says, a tariff-free boom, whereas on the manufacturing side, all of the machinery that would go into those future factories now faces tariffs, whether it's coming from Europe or Japan or China. And that is also something that puts a real damper on investment plans and raises questions over the costs. And those are kind of constantly moving costs as well.
Brooke, I'm so curious about the way that in your world of industrials, the way that AI, if we look at like second order effects here, okay, if this stuff gets built, and if maybe American machines and manufacturing equipment to a certain extent are used to build it, then do we get to a world where the companies in your universe are able to increase productivity as a result of the technology that they helped bring to fruition?
I mean, that's sort of the goal. And if you talk to, industrial CEOs, they will say that, yes, there are short-term constraints here, particularly around people and power, but it's also an opportunity to rethink the way we do things. And maybe we don't need to keep doing everything the same way that we always have. And we can, sort of push technology to that next frontier, whether that's relying more on sort of prefabricating parts of, a building off-site to help improve productivity and reduce the risk of errors, whether it's leaning more on automation in the factories, although, of course, automation in the factories does sort of raise the question of, well, how many jobs is this reindustrialization effort going to provide? And so, I do think industrial companies will rise to the challenge and try to figure out how to solve for some of these shortages, but I think there are bigger questions about the longer term ramifications of that, especially if your goal is to create a bunch of manufacturing jobs in the U.S.
Well, just got about a minute or so left here, and Shawn, back to you. I mean, you guys, I guess time will tell, because there is a line in this reporting that you guys did in this story: if the future of AI is as rosy as its backers painted, then a broader swath of manufacturers will eventually reap benefits from the technology too. Ever more intelligent robots will boost productivity at American factories. You're going to need lots of things to build out these data centers, and that plays into the manufacturing economy. But Shawn, time will tell on this, and only got about 45 seconds here.
Yeah, look, time will tell, and the big question and the big kind of political economy question is, how will people make out? How will workers make out in this, right? We think about AI as something that could make a lot of us obsolescent at some point, hopefully not, but in the manufacturing environment, you can envision kind of highly automated factories that don't lead to a lot of employment, and that is the big promise from Donald Trump going back to his first term, is to bring the factories back, to bring the jobs back. And right now, on the manufacturing side, the U.S. is down 42,000 jobs since April. That's just not happening.
All right. I got to say, though, you guys, the way you kick it off and weave through the GM plant in Lordstown, Ohio.
That is the perfect anecdote.
Highly recommend everybody read it, because you weave through it and how it tells this story so well, as you both did. Shawn, Donnan, and Brooke Sutherland, thank you so much.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.